The word inflation strikes fear into the hearts of many U.S. economists who warn against quantitative easing and printing more money. Others don't see inflation as an economic boogeyman. To calm the nerves, they point to years of sustained low inflation. But what about those who say inflation is like a fine wine, with a modest amount actually improving our health? They argue that inflation will help devalue debt, increase capital investment, and reflect more robust market activity. So, here to discuss inflation, the good, the bad, and the quantitative easing, we have Mike Conzel, fellow at the Roosevelt Institute in Brooklyn, New York; Peter Schiff, CEO of Euro-Pacific Capital and host of the Peter Schiff Show in New York; Eric Scorsoni, economist at Michigan State University in East Lansing, Michigan; and Miles Kimball, a professor of economics and survey research at the University of Michigan and founder of the blog Confessions of a Supply-Side Liberal. Welcome, everyone.
Thanks for having us.
Thanks.
Okay, let's dive in. Opponents of the quantitative easing program often cite that inflation is one reason why we might not like quantitative easing. Money's too loose, pumps into the economy, devalues the dollar. Peter, can you just quickly give us your case for why inflation is happening and why it's bad?
Well, first of all, I think quantitative easing is inflation, simply by another name that might not sound as menacing to the public. But, the natural tendency of prices in a market economy is to fall over time. As you find more efficient ways to produce things, costs come down, prices fall, and consumers take advantage of the lower prices by buying more stuff. That's how standards of living rise. If you look back historically, the most prosperous periods of American history where we had the biggest rise in living standards happened when prices were falling. Inflation, on the other hand, robs Americans of the benefits of falling prices. We have to pay more for the things that we want or the things that we need. And that's what's happening right now. The government is creating a lot of inflation. They're calling it quantitative easing, but the inflation is either preventing prices from falling or causing prices to rise, but none of it is constructive. And unfortunately, what all this inflation is doing is it is further distorting the economy and preventing the market from fixing what's wrong with the economy, which is not enough savings, not enough capital investment, too much spending, too much consumption, too much speculating. All of this activity, which is detrimental to the health of the economy, is being encouraged by the government. It's the same type of policy that created the housing bubble and that led to the financial crisis of 2008. Instead of letting the markets repair the damage, they're simply creating bigger problems that are ultimately going to have to be unwound in a much more painful way than 2008.
Okay, and we can talk about some of the pain in a bit, but Miles, you have a slightly different view, right? You think that quantitative easing is not distorting the economy, or that its effects are minimal. Make the case for us that either inflation isn't happening, or that it's happening in a way that we shouldn't care about.
Well, I wouldn't. Inflation matters, but what I would say is that inflation is now lower than it was in early 2008 before we did any quantitative easing. So whatever inflation we have is not because of quantitative easing. It's actually because of something else entirely. It's because the Federal Reserve chose to have an inflation target of 2%, and they did that for one reason, which is because they were worried about the fact that they couldn't lower interest rates below zero. So basically, the reason we have inflation is because the Fed is worried that they can't lower interest rates below zero. If you take that away, if we simply repeal the law against lowering interest rates below zero, then it would, in the natural course of events, the Fed would lower its inflation target to zero, or it could even have a negative inflation target, and that would be fine. I think zero is the best value for inflation rather than something negative. But a lot of people don't realize that it's this difficulty with negative interest rates, which is something we can get rid of, that and allow negative interest rates, that causes inflation.
Okay, so this can get a little jargony for the average American, but Mike, I was talking to Ramesh Ponnuru of National Review back when this issue started to heat up for conservatives, and he was actually telling me, look, I hate to break it to these guys, but inflation is not happening, so get over it and let's move on. And my rejoinder to that was, okay, but if I'm just sort of like an average American going through my everyday life and I say, gosh, my cost of living seems to be going up, right? Food is getting more expensive, gas is getting more expensive. Whether you call that inflation in a technical sense or not, the experience of the person who's feeling their cost of living going up is more or less the same. So whatever the economists have to say about whether inflation is real or government's reporting it correctly, isn't there this concern that, you know, people really want to know what's going on in their own lives, and when they see their budgets move because prices are rising, then that's going to sort of generate the same kind of anxiety?
Sure. So let's back up. Inflation is when the price of everything goes up. So Peter's absolutely correct that we want innovation. We want things to get cheaper. We want the computer I'm talking into to be a fraction of what it would have cost 10 years ago. Inflation and deflation is when the price of everything goes down. It's entirely a monetary phenomenon. It comes from the Federal Reserve. If the price of everything falls, we're not actually richer. Crucially, you know, the price of, the stock of money will collapse, which makes transactions harder. And crucially, all of our debts, and we have a real, there's a lot of housing debt that hangs on the economy right now, suddenly is worth a lot more, and it's harder to pay off, and those bankruptcies have real damaging value. So we want a small amount of inflation in order to kind of steer the economy, to slow it down when it gets too high and to speed it up when it gets too low. Right now, we've had below trend inflation. Inflation would have to go to 6% for a period of time to even balance us out. So what a lot of people are looking at, and I mean, this is not an exaggeration. You can try to call other things inflation, but if you actually look at core inflation of staple goods, it's the lowest it's been in decades. And that actually reflects a weakening economy. It shows an economy that's in far more danger of relapsing into a recession than what we want right now. So what a lot of people call for is a period of higher inflation. Now, there's a debate about whether or not the Fed can do this, but to give us a little bit more of a steady footing, to bring us back to full employment, these things matter in the short term because it can push up output and get people working, and also reduce the real value of debts that are really holding the economy back.
Okay, Peter, I want to get back to you in a second. I see you laughing over there, but I think you probably don't think something's funny. Eric, I do want to get to you first, though. You're an economist out there in East Lansing. You are seeing what's happening to Detroit from pretty close up. One issue when it comes to inflation is, if you're carrying a lot of debt, whether you're an individual or whether you're a municipality, you look at something like significant inflation and you say, well, wait a minute, isn't this good for me? Because then the value of my debt is actually diminishing as the value of the dollar diminishes too. So do you think that, if you're a municipality and you're worried about your finances, you're worried about maybe going to bankruptcy, that the prospect of increasing inflation is actually something that you might be excited about?
Well, I suppose in a very limited way, Detroit might see some benefit from something like that. But I don't think in reality that's really going to be something that the city of Detroit, there's going to be a lot of negative impacts on the city of Detroit from high inflation. So I don't think that's probably a realistic proposition. And I think that, maybe in a short-sighted way it is, but I don't think that's likely to happen in the environment we're in, and I think that Detroit would be, if they supported such a thing, it would be a short-sighted support for such a policy.
Okay, so Peter, one of the main issues here is just a practical one. How much inflation do we really have taking place right now? Some people are claiming that the government is underreporting what inflation is, or they're not capturing it adequately or correctly. This can be contentious, but what's your view on that?
Well, there's no question that the methodology for computing the CPI has been altered over the years with the intention to produce a lower number. I mean, that's clear. That's what the government wants to do. They don't want to accurately report how bad inflation is. You're right. Inflation does transfer wealth from savers to debtors. The government, being the biggest debtor in the history of the world, certainly has a vested interest in creating inflation. And also, if they want to try to artificially stimulate the economy with quantitative easing, the only way they can get away with that is by pretending that there is no inflation. And, by the way, if there's a weak economy, you want prices to come down because that eases the pain of the weak economy. If your wages are falling, if you're unemployed, it's better if the things that you need cost less money. But that's actually not what's happening. I think there is a lot of inflation that's not being reported, or the effects of inflation. I'll just give you one easy example, and I have plenty of anecdotal evidence. But I looked at the CPI, and over a 10-year period, the official estimate of the increase in the price of newspapers and magazines was 30%. But when I actually examined how much the prices of the newspapers and magazines that the government claimed went up by 30%, they actually went up by 130% during the exact same period. Now, I don't know what happened to the 138% increase when it went into the CPI, but it just came out at 30%. You know, another great indicator, you look at the price of a Big Mac. For about, 15 years, since they had this Big Mac index that they used to measure purchasing power parity around the world. And for about the first 15 years, they had the Big Mac index. The price of the Big Mac went up exactly the same as the CPI. Now, for the last 5 to 10 years or so, a Big Mac has increased in price almost 3 times as much as the CPI. Now, the question is, what's changed? Is the Big Mac different, or is the CPI different? I mean, I think that the Big Mac is the exact same hamburger it always was, but the CPI has been changed. It is not picking up the inflation that exists, but the American public feels that inflation when they go in and they buy things. But one of the reasons that inflation isn't so much worse, and why it's about to get a lot worse, is because we've been able to export a lot of our inflation to our trading partners by shipping dollars abroad in exchange for the real goods that we import. So we run this huge trade deficit, we get products, and people like the Chinese get our inflation. But that's going to reverse when the bottom falls out of the dollar, and then you're going to have a tidal wave of inflation washing up on American shores. And it's going to be so bad that there's no way the government's going to be able to lie about it with the official numbers.
Okay, so Mike,
can I speak to this?
Yeah, sure, go ahead.
Issue of whether quantitative easing is really going to cause inflation. So people think
it is inflation. By definition.
That's just not true.
Yes, it is.
The definition of quantitative easing is when the Fed is buying things other than Treasury bills. So if the Fed buys long-term government bonds or mortgage-backed bonds, then that's called quantitative easing.
But it's called inflation because it has to print money to buy those bonds. It's called monetizing debt.
Printing money,
which is inflation.
Printing money sometimes causes inflation, but the thing is,
printing money is inflation. Sometimes it causes prices to rise.
No, that's just
okay. All right, hold on a second. Let me just put in the interest of moving the conversation forward and focusing in. Let me just ask you, Miles, when doesn't printing money cause inflation?
Well, things are very different now because you have banks just piling up lots of cash. So basically, when money is out there working in the economy, then it does tend to stimulate the economy. And if you overdo that, it's going to cause inflation. But what's happening now is that people are just piling up a lot of cash, and it's not really at work in the economy. The banks aren't lending things out. The companies have a lot of cash on the books that they're not investing. And it just doesn't cause inflation then if people aren't putting the money to work. So the quantitative easing does a little bit to put more money to work, but it's actually a very weak medicine. And so people look at the trillions of dollars and think that the quantitative easing will have all these terrible effects. But basically, it's such weak medicine. On the one hand, it doesn't do as much good as you would wish it would do. On the other hand, it doesn't do that much harm either. It doesn't have either strong benefits or strong side effects at the kind of dosages that we've been doing. Now, you could up the dosage of quantitative easing, that it would stimulate the economy more, it would have more good effects, and it would also have more side effects, and you would start to have to worry about the balance between the good effects and the side effects. But as it is, quantitative easing, because it's weak medicine, just doesn't have huge effects either way.
Okay, I want to loop back here. I want to loop back on 2 issues that we have on the table right now before we lose sight of them. Mike, Eric, I'd like to hear from you on these. Number one, we've got the prospect of wealthy people, people with a lot of high net worth, individuals and businesses sitting on their money, not investing it. And then 2, we've got the question of America's trade balance, how the balance of trade is working, and whether we can sustain that. How are these 2 things going to impact inflation, in your estimation? Is there anything Americans should be worried about in terms of people not investing and in terms of how our balance of trade is working?
Well, right now we have a significant gap in the amount between what we are producing and what we could be producing, and that is largely driven by consumers deleveraging and by corporations sitting on a lot of money. So one thing you want to do in those cases is to use monetary policy to increase the amount of investments. It's very difficult for the Fed to do right now because its normal process is in check. So it can change expectations of future policy, which it's hard to do because it's considered a Fed that's very worried about inflation. We can. I want the audience to come away when most economists talk about measurement errors in inflation. Usually, it's the opposite. It's that inflation is too high because it can't record very well the fact that your phone is much nicer than it was 10 years ago or whatnot. There's a lot of fights, and you can see this in the fights over Social Security, for instance. Economists in general think inflation is overstated, not understated. Price of bread, you can look at the CPI, it's flat. There's a reason we don't look at anecdotal evidence because, there's a lot of changes in the newspaper industry, which was brought up earlier. Inflation is entirely a monetary phenomenon. Right now, all the money that's being pumped into the economy is sitting on the books of the banks. It is not going into the economy, pushing up prices. That's the fundamental problem we have right now. When we talk about inflation going up about 1%, 1.5% right now, we'd actually like it to go back to the rate of maybe the 90s, which is 2.5%, 3%. I think that would bring us back to full employment much quicker. In the short run, this does have an impact on output. I would help with the deleveraging crisis. And I think the Fed has built up so much credibility on this issue that it would be easy to revert back.
How can you say, though, that this money is not getting into the economy? The government is running an enormous deficit. All that money it's spending is being monetized. So the money the Fed is spending, the federal government is spending all this money into the economy. You've got people buying real estate with all this cheap money. You've got stock prices going up because people are taking cheap money and buying stocks. To say that the money that's being created is not working its way through the economy, it's just ridiculous. Of course it's there. And you can see prices rising throughout the economy, in financial assets, in consumer goods. It's there, and our trade deficit is still there. So we're flooding the world with our dollars.
You're saying it's a really strong economy now?
You cut me off. To the extent it's working, it should be working more, and we should be doing more of it because we need an acceleration in the price of consumer goods right now.
Are you saying it's a really strong economy right now? That's what I'm wondering. You seem to be talking as if we have a super strong economy right now, and I don't think most people would say that. If money were working, the economy would be strong.
No. Money doesn't make the economy strong. It's just paper. It's productive work. It's investment. It's capital spending. It's productivity. We're not getting that because we're printing too much money. No, I think we're in a depression, and I think it's going to get much worse because of the policies that everybody else here seems to be advocating. That's why we're headed for a much worse financial crisis than 2008. No, we're in a depression, and it's going to get a lot worse, and we're going to have runaway inflation.
Money doesn't cause inflation unless it makes the economy strong first. It's when you make the economy too overheated that you get inflation.
No, you're giving me this Keynesian nonsense. It's just not true. That's not how it works.
That's technically a Milton Friedmanism, not Keynes. Keynes would have thought.
Well, all right, guys. Let me pull Eric back in here. If you can address the balance of trade issue, because I think one concern that people might have is, if the way the international political economy is going, if that takes a sudden sharp turn, then that might cause America to suffer in a way that maybe we can't anticipate, as well as we might be able to, calibrate the flow of money and that sort of thing. Do you have any concern that inflation is going to be affected in an adverse way if some unforeseen development in the international political economy catches us by surprise?
Well, there's certainly, if something happens in the international economy, obviously there's risk to the U.S., but I don't think it's inflationary risk. I think it's, it's going to be a risk that we're already in a weak economy, and if the rest of the world, we know the rest of the world has challenges right now, and so that would only hurt us probably more. I mean, I think the debate is interesting. This is a typical debate about inflation and what's going on, because you have very different views about what the mechanics are. And so it's very hard to get agreement on these issues. I personally, I have to agree that I think a little bit of inflation makes sense. Nobody wants, very high inflation. But I think, the point about the Fed is trying to stimulate asset prices. And I mean, that's part of the goal of quantitative easing, quite frankly. And I think, this issue about the balance of trade is a set of issues that it's important to address. But, I don't see the issue related to inflation risk right now. If Europe takes a worse turn, I mean, that's going to be bad for the U.S. in a lot of ways. But I don't think it's an inflation risk.
Anyone else have a sense about whether we ought to be concerned about the way that, say, U.S.-China trade might impact our currency valuation?
Well, what we need to be concerned about is when China wakes up and decides they're not going to vendor finance us anymore, they're going to depeg their currency, they're going to stop hoarding trillions of dollars worth of our debt, they're just going to let the Chinese RMB rise in value so their own citizens can consume what they're producing, and Americans are going to have to go without all the things that the Chinese have basically been allowing us to consume for free. Look, this crisis that's coming, to me, this is even easier than it was to predict the financial crisis of 2008. I mean, that was something I was warning about for years. The housing bubble was obvious to me, and there were so many people that I debated with for years who couldn't see the housing bubble and couldn't see the problems that were going to happen in the banking sector when that bubble burst. That was clear as day to me. This crisis that's coming is even clearer. And what's amazing is so many people who were oblivious to what happened in 2008 still don't understand why that crisis occurred, and they still don't understand why a bigger crisis is looming, because the exact same set of policies that gave us the housing bubble and the '08 financial crisis are the ones that we're using now to give us this next crisis. Only the only difference between the policies now and the policies then is they're bigger in size. It's the exact same policy prescription, only a much larger dose, and therefore is far more lethal to the economy.
I'll tell you why we have had these financial problems, and it's not a problem of monetary policy. It's a problem of our financial policy. So the trouble is that we've been letting the banks play in effect with the government's money, with the too big to fail, where if they get in trouble, it's heads they win, tails the taxpayer loses. And the solution to that is to require that the stockholders of banks and other financial firms put up at least half the money that they're working with. And if you do that, you have a better
solution. Just get rid of the deposit insurance. You know.
I assure you, the solution I'm giving you is much better, because it works in a lot more ways. So if the shareholders of the companies are actually risking at least half of the money that's put out there, the government won't be on the hook, and they'll be more careful in how they do things. You know, it's not such a big problem when financial prices go down, when it was like the internet stock bubble in the 2000s, when the shareholders at least bore the risk. I mean, obviously they suffered, but at least the people who should have suffered because they took the risk did. The trouble is when you let banks have like 3%, have just put up 3% of the money that they're risking, then the taxpayer gets on the hook, and that's a big problem.
Yes. Okay, guys, we're running short on time here, guys. So I just want to give Mike the chance to have the last word. And here's what I want to throw at you, Mike, just very quickly. If I'm a person who just has a ton of debt, and I'm looking at my future, and I'm thinking, like, when is this ever going to change? It probably isn't. Feeling pessimistic, maybe a little bit angry, and I think, like, why not runaway inflation, right? Why not just like, let's let this system crash and burn. How bad can it get for me? The alternative is declaring bankruptcy. Bring on the runaway inflation. What do you say to those people?
Well, I'd encourage them to step back from that edge and think in two things. One is that if you took out a loan in 2006, 2005, you paid for 2% inflation. I mean, that was the expected inflation is in your interest rate. The fact that we are below that right now, that we're floating around 1 to 1.5%, is a huge transfer to creditors. So let's keep that in mind for when we're talking about missing the inflation target. I'd say, you know, and then the other thing is that, you know, if you don't have a job, it doesn't really matter what your interest rate is. It doesn't matter what your debt is. You're going to have trouble getting by. So stronger economy is going to make a lot of this deleveraging much easier. There's a lot of jargon here, a lot of confusing stuff for the audience. So let's step back and just say, what is the problem and what is to be done? And for here, I mean, it's very clear to me that the problem is that we're below our full potential GDP, and that we need a monetary policy that balances between real growth and, you know, when that is low inflation, to keep us on a consistent path of everything we could be producing in what's called nominal GDP. I think Peter's arguing that deflation will wipe away the sullenness, and it will, you know, kind of cleanse the field and, you know, really bring in a new vigorous economy. That historically has never worked. Didn't work during the Great Depression. Monetary destruction is always going to, you know, I see no reason to see that is the solution of the problem we face right
maybe
now.
You don't understand history any more than you understand the present. That's part of your problem.
Okay, before things get too ugly, I got to draw it to a close. I know this is contentious stuff. And for everyone out there, I encourage you to dig deeper in and check out what the lines of argument are and figure out where you come down, because it's a hot issue. We're going to keep following it. I want to thank Mike and Peter and Eric and Miles, all of you, for a lively and spirited conversation.
Take care.
Thank you.
Cheers.